On February 4th, 1994, the Federal Reserve did something that most people outside of finance never saw coming. An unexpected series of rate hikes that wiped out over $1 trillion from global bond portfolios. Just like that. One decision, rippling across the entire planet. And here's what gets me about that story. Most people had absolutely no idea it was happening. They were just living their lives, paying mortgages, saving for retirement, running their businesses, completely unaware that a market they'd probably never thought about for a single second was quietly reshaping their financial reality. That market was the bond market. And look, I want to be upfront with you before we go any further. I used to be one of those people. I genuinely thought bonds were just something boring that older folks stuck in their portfolios, so they didn't have to think too hard. Stocks were the real game, right? Crypto, equities, real estate, those were the things worth understanding. Bonds? Bonds were wallpaper. I was wrong. Completely, embarrassingly wrong. Because here's what I eventually figured out. If you don't understand bonds, you don't actually understand money. Not really. Not the way money moves through the real world. So let me walk you through what I wish someone had explained to me way earlier. Starting with the basics, then getting to the stuff that actually affects your everyday life. At its core, the bond market is where companies and governments go to borrow money. They issue bonds, basically an IOU, with an interest rate and an expiry date, spelling out exactly how it'll be repaid. That's it. Simple version done. But here's where it gets interesting. The bond market matters because of its direct relationship with money flow. It's like a real-time gauge of market sentiment, showing us how investors actually feel about where global economies are headed, right now and in the future. Think about that for a second. This market, the one most people completely ignore, is basically the economy taking its own pulse. When bond yields go up, that means something. When they come down, that means something too. It's not subtle. It's the economy talking in its own language, and most of us were never taught to listen. The global bond market hit over $100 trillion as of the mid-2000s, bigger than the global equity market at the time, bigger than stocks. Think about how much attention stocks get. Now think about the fact that bonds are the larger market. We have our priorities completely backwards. The U.S. bond market alone sits at over $51 trillion, 39% of the entire global bond market. That's not some niche corner of finance. That's the foundation everything else is built on. Now, back to 1994, because I think this story is honestly the perfect way into understanding why any of this matters to you personally. Heading into that year, bond yields were historically low and inflation felt like a non-issue. Wages were flat, companies weren't raising prices. Everything felt calm, stable, normal. Bond investors had gotten comfortable betting that interest rates would stay low or drop even further. And a lot of them were using leverage to do it. And then the Fed moved. February 1994. Rates raised to 3.25%. Then again, in March and April, to 3.75%. 0.5% more in May and August. Then in November, the Fed raised rates by 0.75% in a single move. Nobody had expected it to happen that fast. There was a global bond panic. Yields shot up, which meant prices crashed. Stanley Druckenmiller, one of the most respected hedge fund managers alive, lost $650 million in 2 days. And Orange County, California went completely bankrupt because of its own leveraged bets on interest rates. Orange County, a whole government entity, bankrupt because of bonds. I know this is the part where it's tempting to zone out. But stay with me here, because what happened to Orange County isn't really a story about hedge funds or obscure financial instruments. It's a story about what happens when people managing real money, your tax dollars, your pension, your mortgage rate, don't understand the market they're playing in. And that story keeps getting repeated. just with different names and different years. Here's something the finance world doesn't really spell out for regular people. Bonds don't just affect investors, they affect you, directly, right now. Whether you own a single bond or not, the bond market affects what we pay for borrowing costs, a new home, a new car, credit card debt. Everything is tied to prevailing interest rates, so when rates move, it hits home, literally. Let me make that concrete. You want to buy a house, you go to the bank. The bank gives you a mortgage rate. Where does that rate actually come from? Banks have to compete against Treasury bond yields to attract capital. So when yields rise, lenders raise their mortgage rates to stay competitive. Higher Treasury yields equal higher mortgage payments. For you, personally, your monthly payment, shaped by a market you've probably never consciously thought about. And it doesn't stop at mortgages. Higher rates push up the cost of car loans and credit card debt too. So the next time you're sitting across from a car dealer wondering why your financing rate feels brutal, the answer is in the bond market. The Fed has the strongest grip on short-term rates, but longer-term yields respond to growth expectations, inflation trends, fiscal policy, treasury supply, investor confidence. It's not one simple lever, it's a web, and bonds are the web. There's one more thing I want to show you, because I think it's the piece that finally made everything click for me personally. When interest rates rise, the prices of existing bonds fall. Which seems backwards at first, right? You'd think higher rates would be good for bondholders. But think about it. If you already own a bond paying a fixed rate, and new bonds start paying more, your bond is suddenly less attractive. You're locked in at the old lower rate, so its value drops. And here's where it gets really uncomfortable. When interest rates rise, retirement accounts can get hit from both sides. Bond prices fall, and higher yields put pressure on stock prices too. The S&P 500 dropped nearly 20% in 2022, while the Bloomberg Aggregate Bond Index shed 13%, all as the 10-year Treasury yield more than doubled to around 4%. Bonds and stocks down at the same time. Your retirement account taking hits on both ends, because of yield movements in a market nobody ever taught you about in school. That right there is the whole game. It's not about picking the right stock. It's not about timing the market. The single most powerful force shaping your financial life, your mortgage rate, your retirement balance, your borrowing costs, is a market most people treat like background noise. Pension funds and insurance companies typically hold between 25 and 70% of their portfolios in bonds, which means the institution holding your retirement, your life insurance, your pension, it's built on bonds. The whole structure rests on it. The bond market isn't boring. It isn't just for retirees and institutional managers in gray suits. It is the nervous system of the entire financial world, and every time it sends a signal, you feel it. In your rent, your car payment, your savings rate, your grocery prices, your job security. The 1994 crisis didn't just erase $1 trillion. It quietly proved something the financial world has known ever since. The bond market can stop presidents in their tracks, bankrupt governments, and completely change the life of someone who has never once heard the word yield. Learn the language, because it's already speaking to you